how do we trade our mean reverting strategy in FX? Now, let's have a look. We basically just traded on two currency pairs, mostly on the Australian dollar versus the Norwegian crown and the Canadian dollar versus the Norwegian crown. Why are we trading these two currency pairs? Because they tend to be highly mean reverting, as you can see on the chart here. So basically, there's no trend. They're just going up and down, coming back, coming up, coming back again. So this is due to fundamental reasons. That's the most important thing. So the Canadian economy exports a lot of oil, and so does Norway. As a result, both currencies have a very high correlation to the price of oil, and as a result of that, the currencies, if you trade them against each other, tend to be very mean reverting. Now, the important thing here is that the underlying basis of the strategy is a fundamental basis, which is why we believe this will also keep on continue for longer in the future. And this is basically also the reason why we chose these two currency pairs, because they have the highest mean reversion among most, or basically all G10 currencies. All right, so now let's have a look at the backtest of our mean reverting strategy. Now, here you can see the results of the backtest. We're only going to show basically the trades when we entered and when we sold. So, as you can see, this is highly mean reverting, and as a result, also the strategy makes quite some good profits. Basically, you can always see around the highs we sell, and around the lows we buy. Now, this is quite interesting, but let's see the equity curve as well. So here we can see the equity curve, quite steady. It keeps on making money every year with few drawdowns, but that's normal. Every strategy has some drawdowns. And all the way until today, you can see this. You can also see the size is, of course, increasing of our positions because the portfolio size is increasing as a result. The position size has to increase as well. Now, something else that is very important, though, is, of course, the statistics. Now, let's have a look at the statistics here. The initial deposit was $10,000. We started 17 years ago, so that's around 2007. And you can see here the total profit, which is at 524,000, which is quite a lot. The profit factor is also very high at 26. And more importantly and more interestingly, let's have a look at our hit ratio. So in total, we are right around 87% of the time, so most of the time, which is quite good. But what is far more important is to have a look at what our average loss is versus our average trade. Because this alone, this number doesn't really help us. We need to know if, in this case, we can still expect positive expectancy given by the average profit rate and the average loss rate. So here we can see the average profit rate is around 3,785. The average loss rate is not even $1,000. So with this, we can see this is almost a ratio of 1 to 4, a little bit less. But this shows us that together with the amount of trades that are profitable, we have a very high probability for the strategy to make money also in the future. All right, so this was just a very quick explanation of our strategy. We will be happily doing more videos to explain this a little bit further, but this is just the beginning to have a look at how the strategy works overall and why do we implement it in this manner and on these currency pairs. All right, happy trading.